Hi, everyone, and welcome back to the channel. In today's episode, I'm going to talk through the 20 most important items that you will likely want to have a plan for before going into retirement. I'm Joe Ward, a certified financial planner and a retirement income certified professional. So I work with a lot of retirees and those that are close to it. And of all the people that I've worked with that have retired, these are the top 20 items, and let's jump through them. First and foremost, retirement and reaching financial independence are not exactly the same thing. They can coincide, but oftentimes, obviously, you'll want to become financially independent before actually taking the leap into retirement. But how do you do that? Well, first and foremost, you have to understand your baseline expenses. The easiest way to do this is just to link up your bank and credit card accounts to an online provider like Monarch Money or one of these other tools. That's going to give you a really good understanding of the monthly and annual cash flow. I think that's super important. And it's not like you're having to meet that budget every month or follow Dave Ramsey's envelope system, but it does give you a baseline. Now, above that, you want to tack on those large expenses, maybe a kid's wedding or grandchild's tuition, car purchases, all the things that you're not able to just track with the month-to-month spending. When you have that number, those are the expenses, but then you want to look at what guaranteed income might you have coming in. And it may not be today, it might be in the future, in the form of a pension or an annuity of some sort. The most popular one being Social Security, of course, that a lot of my clients are taking at age 67 or potentially delaying for a higher benefit at age 70. But lots to say on Social Security. I'll leave that to a different video. Once you have those income items and expense items, you can then calculate your burn rate, so to speak. That's the percentage of these living and large one-time items as a percentage of the total investable assets. So let's just look at a case study here that shows these items at a high level so you can get an understanding of kind of what I'm talking about. So if you have 10,000 of living expenses, call it 120,000 a year. You've got 30,000 of these lump sum type expenses that you expect annually. And then once you start Social Security, you'll have 60,000. That's just assuming between the couple, 60,000. And then you need to come up with 90,000 from somewhere. And obviously, that's where your saving for the decades before retirement comes into play. But what we want to do to make sure that your spending rate and your net worth align and are healthy, right? And so here I have 3, 4, 5, and 6% spending. What would that mean you need to have in your portfolio? So if you want to be really conservative and just spend 3%, then 90,000 in spending would mean that you need a $3 million portfolio. If you are older or don't have as much longevity or whatever it may be, maybe you're willing to spend 6% per year. So mileage is going to vary person to person. And there are lots of different things that you'll want to put into your plan to figure out what makes the most sense for you. Okay, moving on, let's go to our investments now. So cash is a really big item. You want to have some funds for emergency reserves, but a lot of times for my clients, I just earmark that short-term emergency fund and I put that into their bond position. So it's something that I'm managing that they're not going to have to manage. That leads into what is your asset allocation? All of the different things that you thought through when figuring out your ratio of spending to net worth. And if you want to go on the conservative versus the aggressive side, those are all the same things that we think through when determining your allocation. Your risk aversion, how much time you have in your plan. And once we get the high level allocation, we're able to then locate those assets in the most tax efficient manner. When you then withdraw from the accounts, there are different rules from a tax perspective And let's just talk through those real quick. So a lot of people will be familiar with using a traditional pre-tax type IRA while they're working to get the tax deduction when they're at the high marginal income rates. But then when you take that money out, Uncle Sam wants their cut. And so you are taxed at ordinary income. Roth accounts are different. You've already paid the taxes on those funds. So when you take the money out, it's tax free. A lot of my retirees are not taking money out of the Roth. That's kind of the last bucket that they would want to draw from. And a lot of times that is best used as an estate planning inheritance transfer tool because your heirs will be able to keep those funds invested for an additional 10 years before having to pull them out. Lastly is the taxable brokerage account. There aren't any rules on taxation just for taking money out of the account itself, but you might have to sell investments to free up that cash. And that could come with short-term, long-term capital gains or losses. When there's a net gain, you're going to have to pay the tax at long-term capital gains rates. And then interest and dividends that are produced along the way are being taxed on a yearly basis. Next is Roth conversions. And this is basically just taking money from the traditional account and putting it into the Roth. So you've already put money into the traditional and you're able to avoid, let's say, 35% tax rate while working. Then you're in retirement for a while and you have control over your distribution strategy and therefore taxes. But then at age 73 or 75, depending on when you were born, you're required to take money out of the traditional IRAs and 401ks. So if you put it in at 35%, you'll want to know what you're going to have to take it out at. And a lot of times the best situation would be that slowly and with a very methodical process, you want to pull forward those taxes and realize those taxes now rather than waiting until you're required to take them out. It's a tax arbitrage game where you put it in at 35. If you wait, you might have to take it out at 24 or 35%. But if you're able to do a little bit along the way in retirement, you can substantially reduce that lifetime tax bill. Should probably make another video on that because there's a lot on the Roth conversion side. Let's move on to healthcare though, because this is a really big ticket item that I see keeps people in their workplace because it's just such a nuisance figuring out what you're going to do on the healthcare end. There's a few main items though, and the most obvious is Medicare at age 65. So if you've reached 65 or older, your decision's going to be mostly made for you. You just have to figure out what Medicare plans you want. If you are pre-65, you've got a few options though as well. There's COBRA, so that's just continuing your workplace plan, but you have to pay your work's portion in a small premium to be able to have that coverage for 18 months. That can be a good bridge to Medicare though, and you don't have to have a lot of things change. But you can also sometimes, if your employer had it, go on their retiree medical coverage. I don't see this making a whole lot of sense most times, but there are a few companies that have pretty good coverage. The next one is marketplace plans. This is formerly known as the Obamacare plans, where you get Affordable Care Act credits for these plans based on your income. A ton there, and this whole system is kind of being revamped as we speak. But a lot of times that can be really great for early retirees. A few other ones, I have some clients who have been on VA benefits, and even ones that are within an Indian tribe, a part of that nation. They're provided these healthcare benefits as well. So pretty cool. And it's all on a person-to-person basis. Now, Medicare, we already talked about age 65. I usually actually use a broker to help my clients set up which Medicare plans they want in that first year. And then we can generally use that going forward. But when you're talking about Medicare, you also have to talk about IRMAA brackets. And this starts to occur 2 years out from Medicare. And what that is, the Medicare administration is looking at your tax return and seeing, okay, is this a high income person? What do their earnings look like? If they did make, or if they were taxed on 200 plus thousand of income, we would like them to pay an additional portion, a surcharge into the system, help keep the system afloat. You don't get any better coverage for this, unfortunately. It's just their way of keeping the system funded and additionally taxing, if you will, although they're very specific that it is not a tax to help out with the funding. So anyway, the last thing there is kind of a combination of medical coverage and investments is the HSA. The HSA is the only triple tax advantage account. You get to put money in pre-tax, it can grow pre-tax, and then you actually can take it out if you're paying for an actual medical expense tax-free. So it's one of the greatest accounts out there, but sometimes people don't spend all of it. If you pass away and your spouse inherits the account, they can use those funds for their benefits and get that third tax advantage. But when you both pass away, your non-spouse heirs end up losing the advantages. So it's one of those use it or lose the tax advantages to the account that you want to be aware of. Last couple items here, just kind of a la carte, are simplifying your accounts and your investments, especially as you age. Maybe it makes sense to simplify the investments to make things easier for yourself from a rebalancing perspective, but then also just consolidating the accounts into the same custodian, having fewer accounts to have to manage. I think simplicity is really good here for people as you're aging. And then ultimately, the last benefit is just that if anything were to happen to you, someone would be able to step in on your behalf and they wouldn't have to know about all these accounts at various institutions and all the different things within said account. So it just makes things easier for your trustees, your power of attorneys, your kids, or whoever it may be. And we can't talk about that without talking about end of life documents. So wills, trusts, powers of attorney, healthcare directives, etc. You want to have all of those things in place just to make things easier on your loved ones when that time comes. And last two items here, home equity, I think about as the silver bullet for all the various things that are hard to plan for. If you have a long-term care event, that can get really expensive. Maybe some other things happen over time, bad market scenarios, whatever it may be. We know that we have that home equity as a last resort in these situations. And so I don't put that in the net worth number to figure out what percentage your expenses are to your investable assets. I just, as a conservative measure, leave that aside and you just have that, like I said, silver bullet at the end. Now, the last thing is having a plan, and it's more than just these items here that we've talked through. It's really having a plan of what you're going to be up to in retirement. What does retirement look like for you? A lot of times when my clients leave their companies, they're leaving a community that they've had for multiple decades. And they're also going to have a retirement for multiple decades as well. And so I think you really want to have it mapped out. What are the things that you're going to be up to on a day-to-day basis? Who's in your community so that you can keep those relationships going, which really helps with quality of life and longevity off into the future. And then all the other things to stay healthy. And, you can only play golf so much and clean the garage as well. So you'll want to have a plan. I think that'll make your retirement a lot more interesting, fun. And if you have any questions on any of these items, feel free to reach out anytime. Thanks.